The crash of 1929 versus 2008. How two crises changed the financial world. Two financial crises, separated by almost 80 years, yet eerily similar in their impact on the global economy. The crash of 1929 and the financial crisis of 2008 reshaped the financial world forever. But what caused these crises, and what can we learn from their similarities and differences? Let's dive in. The Roaring Twenties, an era of economic boom, innovation, and optimism. People poured their money into the stock market, believing the good times would last forever. By 1929, stock prices had soared to unprecedented levels, driven by speculative buying and easy credit. But this optimism was built on shaky foundations. Many investors were buying stocks on margin, borrowing money to fund their investments. When confidence faltered, the bubble burst. On October 29, 1929, known as Black Tuesday, the market collapsed. The Dow Jones Industrial Average fell nearly 12% in a single day. Over the next 3 years, the market lost almost 90% of its value. The Great Depression that followed left millions unemployed and led to widespread poverty. The crash revealed deep flaws in the financial system, leading to sweeping reforms like the creation of the Securities and Exchange Commission, SEC, and the Glass-Steagall Act to regulate banks and protect investors. Fast forward to 2008. The world had changed, but history was about to repeat itself in a new form. The years leading up to the crisis saw a housing boom fueled by subprime mortgages, risky lending practices, and complex financial instruments like mortgage-backed securities. Banks and financial institutions packaged these risky loans into securities and sold them to investors worldwide. When homeowners began defaulting on their loans, the entire system unraveled. The tipping point came on September 15, 2008, when Lehman Brothers, a 158-year-old investment bank, declared bankruptcy. Panic spread through global markets, triggering the worst financial crisis since the Great Depression. Both crises share striking similarities: excessive risk-taking, lack of regulation, and a bubble driven by speculation. In 1929, it was the stock market; in 2008, it was the housing market. Both led to widespread economic hardship and global repercussions. But there were also key differences. In 1929, the government initially took a hands-off approach, allowing the economy to spiral further into depression. In 2008, massive intervention, including the $700 billion TARP bailout, helped stabilize the financial system. The 2008 crisis also highlighted the interconnectedness of modern global markets. What began in the U.S. housing sector quickly spread worldwide, sparking a global recession. Both crises led to sweeping reforms. The aftermath of 2008 brought the Dodd-Frank Act, aimed at reducing risks in the financial system and increasing transparency. Despite the devastation, both crises also led to important lessons. The 1929 crash taught us the need for regulation, while 2008 emphasized the importance of oversight in complex financial systems. Today, the markets are stronger and more resilient, but the lessons of 1929 and 2008 remind us to remain vigilant and avoid the mistakes of the past. History doesn't repeat itself, but it often rhymes. By understanding the causes and impacts of these crises, we can make smarter, more informed decisions as investors. What do you think? Could another crash be on the horizon? Let us know in the comments below. Don't forget to like, subscribe, and hit the bell icon for more insightful videos.